Um, Thank you so much for giving me your time this evening. And just first with this disclaimer that all signals and trading opportunities provided both orally, written, or electronically that are disclosed to visitors or our subscribers are for educational and demonstration purposes only. Right Line Trading takes no responsibility for any participation by visitors or subscribers in the futures of Forex or stock markets or for any profits or losses that may be incurred. We all know that trading involves substantial risk, and it should be understood that a person can lose a substantial amount of money. Therefore, participation in the markets is not appropriate for everyone. Carefully consider your financial position prior to trading. Do your own due diligence. You may want to consult a financial advisor. And Right Line Trading is not a registered financial advisor, not a licensed commodity trading advisor. Now, with that said, just a little bit about myself. I just want to, and that is, I'm a graduate of the University of Pennsylvania. I'm a former professor at Jefferson College in Philadelphia. I published close to 15 peer-reviewed articles in first-year journals, and I've been involved in the financial markets for close to 20 years. And Right Line Trading is a product of over a decade of analysis of price action, market structure, and indicator algorithms. What we base our software on is mathematical modeling of closed systems. And in mathematical modeling, we look upon each financial market as a closed system. And what we try to do is determine what forces come to bear on price in that closed system to determine exactly how price is going to move off the right edge of the chart. If we define these forces, we place them in a multivariable equation and optimize them, and thereby can predict with great precision exactly, again, how price is going to move off that right edge. One of the fastest growing trading systems on the NinjaTrader platform. Now, the system I'm going to show you works on futures, Forex, and stocks. All the indicators have forward-looking ability. They do not lag price, they lead price. And again, the software is purposed to predict the future movement of price on any market and on any time frame. Now, if a piece of software is not purposed to harness the fundamental forces that move price, it may be market specific or time specific. And if it is, then it is inherently broken. Any system that does harness these forces correctly is going to be time independent. You can work on a 1 minute, a 5 minute, any type of range chart. It does not matter. And again, it's going to work on any market, any stock, any Forex pair, and any future. Now, just a little bit about Unorenko bars. Now, the system can be traded on time, tick, range, Renko. It doesn't make any difference. But I just want to talk really briefly about why I like Unorenko bars. Now, a lot of you may not be completely familiar with Unorenko bars, and I'm not really going to go into them in detail. But if you see them here, these are Unorenko bars. And these are, we call them modified Unorenko. We have created them, and they're unique. Now, what they do is they obliterate price action to some extent. So I'm sort of giving you the negatives. So as far as price action is concerned, they're not going to tell you who's in control of the market, the bulls or the bears. And with Unorenko, you cannot really evaluate Japanese candlestick patterns. You can't see an engulfing candle, a dark cloud cover, a piercing candle, a doji. These patterns are not apparent. And it's difficult to discern a rising and falling triangle, although you can see channels pretty well. But what I want to tell you is why all of this no longer works, and why, if you buy into Japanese candlestick patterns, price action trading, rising and falling triangles, etc., you're really gonna go off the cliff, along with the other 95% of day traders that have been trading these patterns for close to 40 years. And the bottom line and our thesis is that when the Japanese rice traders created Japanese candlestick patterns, they base it on the following premise: that essentially the power of each buyer was equal to the power of each seller. Now, 400 years ago, when they developed this, the stock market wasn't even around. But when the stock market first came into existence, and then for many decades afterwards, this was true. The market consisted of essentially small traders like us determining whether price was going to rise or price was going to fall. So price action traders were really able to get a good handle on the direction that price was going to move. If you look at Gann theory and you look at Elliott wave, they are all market sentiment based patterns based on mathematical derivations, all with the common underlying thesis that essentially the power of each buyer is equal to the power of each seller. The same thing with rising and falling triangles, even channels to some extent. But what is operational in today's market is different, and that is 70% plus of all volume crossing in the forex markets, the futures market, and on any given stock is institutionally driven. So the power of each buyer is no longer equal to the power of each seller. It's the institutional traders, the big banks, the big financial firms like J.P. Morgan Sachs, Bank of America, the computer-driven algorithms that are triggered by one of these big institutions. It doesn't matter when they trigger what the Japanese candlestick pattern is, whether it's a rising or falling triangle. They're going to push the market in their direction, and they're going to do it, for 50 or 60 ticks, or 50 or 60 pips, or for $2 or $3 or $4 on a stock. They rule the market. So that thesis is no longer in operation. And the same thing is true of divergent signals. If you try to trade them, some of them work, most of them fail. The reason, again, is because of institutional money. They drive the market. Now, if you look at day trading and swing trading as a science, there's no evolutionary process that's taken place in day trading. In a normal science, via rigorous testing, we embrace the things that are right and we discard the things that are wrong. In medicine, we test a specific medication. If it turns out after doing a test on 10,000 potential patients, 5,000 in each arm, the medicine works, we wind up giving it out in the pharmacy. If it doesn't work, we kick it out and it goes into obscurity. That does not take place in this science. Day trading and swing trading do not evolve. I mean, nobody treats it as a science. And essentially, what we have been trading, what we trade today, the underlying indicators and the underlying thesis by which we are supposed to call a price direction, is essentially exactly the same that was used 40 years ago. So as an evolutionary science, day trading has failed, and has failed us. Nobody will ever tell you, oh, this no longer works anymore, it needs to be discarded. Oh, I have proven this works, so we are going to embrace it and make sure it's part of our indicator system. And that whole process, for some reason, just doesn't work here. So that's the reason why 95% of day traders go broke, and that number never improves. So this is the underlying thesis that has changed, and that is the power of every buyer is no longer equal to the power of every seller. So Elliott wave, Gann theory, even Fibonacci, Japanese candlestick patterns, price action trading, rising and falling triangles, all of that stuff is going to throw you off the cliff. It's been around for 40 years and it's never made anyone any money. Now, what we used for the core of our system is called the three-line indicator. Now, I want to show you how this creates a really powerful forward-looking analysis, not a lagging analysis. Now, the first force that we harness to determine the direction of price off the right edge of a chart is order flow. Now, order flow is a really, really powerful determination of who's in control of the market, the bulls or the bears, and what it's looking for is to grab hold of every institutional move and get us in early in a leading capacity. Now, if you look at simply one candle, and this could be on the stock market, so this is going to be cents each level here. In Forex, it's going to be pips, and in futures, it's going to be ticks. But what this number tells us above is that on the dome, there's the 2985, which is a little blurry. There's an overabundance of buyers on the dome. Now, if there's an overabundance of buyers on the dome, one would suspect that there's going to be buying pressure in the candle, and the candle's going to close to the upside, and it does. Now, this is the volume ladder, and inside it are stacked sellers and stacked buyers, and there's software systems that tell you to use these or leverage these to try to trade, or simply the market delta, or simply volume ladder. But nothing on your trading chart has the power to provide you with a leading analysis. Now, here's also market delta. It's a positive 222, yet the candle is closed to the downside. And the reason that is even though there's an overabundance of buyers on the dome, the sellers are more aggressive. So let's say this is a stock that's got a price of 50. Well, the buyers are only willing to take it at $50.01. But the sellers are willing to take it at $49.99, $49.98, $49.97, maybe even $49.96. The point is that even though there's an overabundance of buyers on the dome, the sellers are more aggressive. And because they're more aggressive, even though there's a positive delta, the candle closes to the downside. Now, if this is going to take place, how can you use a market delta off your trading chart to determine how price is going to move off the right edge? And that's what most software systems do. Here's simply the market delta of each candle, and you're supposed to read that. And when you look down, you're going to see the absolute value of the delta is rising here. And as the deltas rise in value, you're supposed to make the assumption that price is going to move up off the right edge of the chart. The problem, as I said, though, is that sometimes the candle closes in the opposite direction. Here's a minus 2,239 on an up candle because of how aggressive the buyers are. So in order to harness order flow as a really powerful way of assessing who's in control of the market, the bulls or the bears, we have to change the way we do the analysis of our indicators for every type of indicator that we do. Now, and the first and most important thing is that the indicator cannot assess any information that's based on price on our trading chart. Nothing that takes place on our trading chart. Remember, there are only five parameters on a trading chart. There's the high, low, open, close, and the sixth is this sophisticated way of determining volume. What we have to do is throw out all the data on our trading chart and look to the two higher time frames, because that's going to determine where price is going to move. And the data from the two higher time frame charts is what's going to determine whether we're going to go long or whether we're going to go short. So all this information has got to be discarded and ignored. And what we do is we look to the two higher multiple time frames. Now, if you're trading a 2-minute, the higher multiple is 3 times 2 is a 6-minute, and 6 times 3 is an 18-minute. If you're trading a 5 range, the higher multiple is the 8 range and the 13 range, the two higher Fibonacci time frames. If you're trading tick, you're trading a 377, it's going to be your 610 and your next higher fib number. But the assessment of order flow is always made off the two higher multiple time frames. And that's built into the algorithm of the indicator. If in any way we incorporate any data from our trading chart, it will ruin the assessment. Mathematically, it'll turn an independent variable into a dependent variable. And once this becomes dependent on price on our trading chart, it will not work. So we just look at the two higher time frames. Now, what do we do about those market deltas that in which price closes in the opposite direction? Well, those are outliers, and one standard deviation's worth of market delta data works, and the outliers are what we have to throw out. So what we do is we place each of those market delta values into a 15-period simple moving average. So what tells us whether the bulls or bears are in control of the market is the average of the last 15 market deltas. So that occasional delta that closes in the opposite direction is factored out because we're looking at the last 15 values. And we have two SMAs, one off of each higher time frame. And when both 15-period SMAs are sloping up, the bulls are firmly in control of the market. And when both 15-period SMAs are sloping down, the bears are firmly in control of the market. So when our order flow assessment line is green, we can only go long. When it's red, we can only go short. And when the 15 periods are not in agreement and the line is yellow, we don't trade. And making sure that we do not trade and chop is one of the keys to becoming a successful trader. Now, I have 175 traders in my trading room, and when they first come in, I ask all of them, what's the most important goal that we have when we swing trade or day trade? And almost all of them say it's to get winners. But that is wrong. The most important goal we have as day traders and swing traders is to avoid losers. If we can avoid losers, we will become incredibly successful traders. Anybody can get winners. I have an 18-year-old son, and if I give him 10 minutes of training, I can guarantee you he'll find winners. But he will get a ton of losers. That's our goal, to trade with specificity. Specificity tells us that we must do everything we can to avoid the losers, and just by virtue of our system, we will fall into many winners. So here's the order flow line. And when it's green, you have got to trade long. And when it's red, you have got to trade short. Now, what's really important about this, and we see it every day, is that the order flow line, because it's off the two higher time frames, is going to lead price. So you see price is going to fall into into an order flow line that's turned green. And that first pivot up is the one that we're going to take heading up. Now, who's taking this counter trend trade? Maybe that was you before. Maybe you were trading fib resistance or oscillator or MACD divergence or Elliott wave or Gann theory or price action or Japanese candlestick patterns. Well, like I said, this is an institutionally based move. Because only institutional money can create a multi-time frame alignment of order flow. And since it leads, you want to get in on that first pivot. Let the counter trend traders try. But all they succeed in doing is helping the move to go to the upside. Because what happens to everyone in this counter trend candle as they get stopped out, they help push the trade to the upside. So if they've sold contracts or they've sold lots or they sold shares of stock, they're going to have to buy them back and as soon as they start feeling the pain of the continuation of this move up. And there's another example. The market is coming down, order flow line turns, and up we go. Again, there are always going to be traders in the counter trend direction that we're going to be very happy to see trading some methodology that doesn't work. Because as price continues up, they're going to get run over and up we go. Here's another example. Have to trade long and up. Can't trade at all. We have yellow. Only short and only long. And now the important thing is we don't want to trade and chop. Now right now we only have one line, so it's a little bit harder to make out chop off the right edge. But when the line continually changes color, price is going to move up and down. And who's in control of the market here? Well, we are, the small trader. I mean, and we're just taking the price and it's moving really in a chaotic fashion. When the institutional money comes in and aligns order flow, up we go. And we have to trade in this direction. Now, the second assessment that we use is momentum. And there are lots of ways of assessing momentum. You can use an oscillator, you can just use Heikin-Ashi momentum, but we just choose to use the MACD because it's got two events. Not only does it have the MACD line, it also has the cross of the MACD with the signal line. So all we're looking for, and again, if we use this off of our trading chart, it's going to confound the assessment. The MACD on our trading chart is a lagging indicator. If we try to use it, it's not going to work. It doesn't matter what the inputs are, and I see people putting out magic inputs all the time, that somehow it's going to turn the MACD into a leading indicator. The MACD on your chart will never lead price. It will always lag. But it does create a nice momentum assessment. And when the MACD line is accelerating away from the signal line, momentum is to the upside. When the MACD line is accelerating towards the signal line, then momentum is to the downside. Now, the actual assessment, I just wanted to drink some water, is a little more elegant than this. I'm really giving you the core concept of how the indicator works, because it also assesses this crossover of the MACD line vis-a-vis the signal line. And what we do is we look at the higher multiple time frames. Same time frames we look to assess order flow. On a 2-minute trading chart, we're looking at the 6-minute and the 18-minute. Again, 5 range, 8 range, and 13 range. We always take the 2 higher Fibonacci numbers. If you're not trading a chart on range that's a fib, we default to the nearest fib and then take the 2 higher. the underlying thesis remains intact, that you cannot look at any data from your trading chart in order to determine how price is going to move off the right edge. We have to look at only the two higher time frames. So when both, and this is momentum line, but it should be MACD line. So when both MACD lines are accelerating away from the signal line, our momentum assessment is green. And when both MACD lines are accelerating towards the signal line, then our momentum assessment is red. And again, when the MACD lines are not in agreement, we get a yellow line and we don't trade. Now we're trading with more specificity because we're adding order flow to momentum, or momentum to order flow, and both of those higher time frame assessments must be in alignment in order for us to trade. And again, this is a really good example right here of how this green line, price will fall into it, and it's going to turn green first, and then you're going to take that first pivot long. Here, when they're red, you're going to take that first pivot short. And now it becomes easier to define chop. No green, no trade. No red, no trade. And you have an absolute direction that you have to trade. And if you don't, you're going to get stopped out. Now, it's easier to define chop, because when you don't have an alignment of these two key forces that move price is going to move in chop. And then when you do get an alignment, down you go and up you go. And down you go and up you go. Now, there are going to be other rules that we have that's going to prevent us from taking trades in certain directions. But we always trade in the direction of the alignment of order flow and momentum. Now, it also allows us to stay in a very long trade, because when institutional money is driving price, and institutional money produces enough buying pressure to keep that MACD line accelerating away from the signal line and keep that order flow assessment, those two moving averages, the delta moving averages with the slope up, we can stay in price. We can stay long. And in this move was so powerful, there were no counter trend traders, but you see they're there. They're trying to create a wick. Those are the bears trying to turn price and do it unsuccessfully. Turning price unsuccessfully. Again, turning price unsuccessfully. And every wick we run them over and we push the trade higher. Now, you may have seen software that tells you we can call a bottom or a top on a mathematical basis. That is simply absolutely impossible to do. You cannot call a top or a bottom based on any mathematical derivation, because they're created by institutional money. We all know, and we've all seen markets that stay overbought for days, for hours, days, weeks, even months. Now, if we try to fade the market based on oscillator divergence or MACD divergence, we're going to get run over. The market's going to turn when institutional money allows it to turn. And institutions rule the market. And we've got to trade with them and beat the other small guy and take his money home. And I get very upset every morning between myself and everyone in my trading room if we can't beat the other small guy and take his money home. Because that's our goal. We can't. The institutional traders always win. Big money always prevails. It sets the trend. We are up against the other small trader, and there's no reason why we can't beat them out. To let them take our money home, I consider it to be a sin. Religion aside, I consider it to be a sin. We should take their money home. Again, chop. Red, short only. Now, the last force is stochastic. And we do the same assessment off the higher time frames, only we looked at the stochastic line a little bit differently. When both stochastic lines are overbought or above the 80 line, we don't look to fade the market. And we're not looking for a divergence signal. That tells us that there's so much buying pressure in the market, we only want to go long. And when both stochastic lines are oversold, less than 20, we only want to go short. Now, when the stochastic lines are in between 20 and 80, the determination is based on where the stochastic line is vis-a-vis the signal line. When the stochastic line is above the signal line, you get green. When the stochastic line is below the signal line, it's red. And when the stochastic assessment is not in agreement, the line is yellow. Now we have 3 lines, and it gets so complicated. Remember, these are changing intra-candle, that what we do is this. I'm just going to skip this. I'm even going to go a little bit further, right to here. What we do is we project the results of the 3 line onto the candle halo. We don't want you to take your eyes off of the price. We don't want you to have to look at the 3 line. Only look at the candle halo. Now, the candle halo, the color and thickness are determined by you. I like to see this is a yellow or gold halo when the 3 line is aligned to the downside. And I like a blue when the 3 line is aligned to the upside. But you can decide how you want to color it. And you can see price rises on this yellow halo. That tells you that order flow, stochastic, and momentum are already aligned to the downside. And 80 to 90% of the time, this up move is finished. And you take the first down pivot, and down we go. Now there are other reasons why you will not take this long. You look for the first down halo, and you're going to take this pivot short. These set of counter trend traders are doomed because they're going long on a 3 line aligned to the downside. And you're going to take the short pivot, and down you're going to go. And remember, these counter trend traders only help us. They're going to have to buy back whatever they sold, whether it's lots, contracts, or shares of stock, and help push this trade to the downside. Now, since we're only looking at the candle halos, we don't even need the 3 line anymore. All we need is the halo. And that's all we need to look at. You can see there's the down candle with the 3 line aligned to the upside. I see that all the time. That tells us that the downside is about over, and the first up candle is going to give me my entry. Now, even though the 3 line was aligned to the downside here, I'm going to show you later the reasons why we're not going to take that short. We're looking for the first up alignment on the 3 line, and up we go. And here's the alignment to the downside and the alignment to the upside.
Hey, Mark, I hate to break in here. Do you think you can wrap up in about 5 minutes?
Okay, I'm about to really quick. Here we have it again and again. Now, I just want to talk about the exponential oscillator. The exponential oscillator gives us our entries. Here's an up entry. Here's a down entry. Here's a down entry. Here's an up entry. And we also have to have the assessment of the 3 line indicator in order to take the trades. Now, I wanted to show you the live platform, but I'm just not going to have the time to do that. I'm almost going to have to go to the offer, but I just want to make one more point. We want to trade off a mean price. Mean price is going to give us the biggest moves. And you can see when price is sitting on the mean, on the 50, the long signal in the direction of order flow, stochastic, and momentum pushes us for the longest move. This is a really nice move. But as price starts to hover above mean, price gets extended, and some of these trades we don't take. I mean, it's a rule-based system. And if you come aboard, I'm going to give you a master class. And I think we have a master class coming up on Monday. And I'm going to go into all the detail and nuance, all the rules we use to trade the system. But we only trade in the direction of order flow, stochastic, and momentum, long above the 50, short below the 50, with an oscillator signal right here. It's a system-generated signal that's really easy to see to take us into the trade. Now, let me just go. You can see you can take a real long trade here when institutional money is driving price to the upside, and a real long trade here when institutional money is driving price to the downside. Now, I purposely didn't put the instrument, I didn't put the time frame because it's irrelevant. This is market independent, futures, forex, or stocks, and it's time frame independent. It doesn't matter. So I didn't want to put a 2-minute or an 8-minute or a 15-minute. We have traders trading a 1-hour candle, a 2-hour, some trade daily, some trade range, some trade tick. I like to trade Unirenko. Now that was the Forex system. Now what I'm going to do is run over to the offer. That's about all the time I have left. And let me just go through all these. Now what you're going to get is you're going to get the Trend 3 software. And you're also going to get a quick start guide. Now the quick start guide can get you up and running in 15 minutes. If you have any technical ability, if you don't like me, you're going to, we'll do a white glove installation for you. We'll do the entire configuration. Now, this works on a lot of platforms. I don't have time to go into all of them. But it worked great on Ninja, great on Thinkorswim, and we'll configure the system for you. Now, you get the best stock assurance checklist. It has to do with going over your trades after hours and making sure that every entry you took is really a perfect one. You get free lifetime updates. We're always upgrading the system and making it better. You get those updates and upgrades free of charge. And you get VIP support. We're always here in the office. I mean, we pretty much live here 10 to 12 hours. You're never going to get voicemail. You're never going to get an answering service. We're here to support you, both technically and educationally. Rory's awesome on the phone for trading support and for technical support. Sergio has a master's degree in computer science. I'm here to help you with your trading. Now, the first 5 orders get my options alert newsletter. Now, this alert newsletter has been broken up into 2 components. The first one, I'm not even going to show you the curve. It's up. If you started with $2,000, you'd be up to $22,000. Is the perfect. Well, you get the perfect options module, which is going to teach you how I trade options. It's a 6-hour digital class, and I trade options differently than most. And this is only for the first 5. Now, here, what I wanted to show you, the other, besides the options, you get the small biotech calls that I make. And what I do is I meet with 5 professors at the University of Miami. Professor of Hematology Oncology, Immunology, Cardiology, Neurology, and Gastroenterology. What we do is we look at all of the medicines coming up for phase 2 approval or phase 3 approval for micro-cap and small-cap biotechs. And we make a decision as to whether or not that medicine is going to get approved or denied. I started this service about 14 weeks ago. We've made 11 calls, and we have 11 winners. And these are the actual performance. We have a 340% winner on intracellular therapeutics, 66%. I don't have time to go over all of them. Clearside, actually, we bought it at around 50 cents. It's now closing on $4. I sold it way too early, but we are perfect on our micro-cap biotech stocks. And today alone, on the options, I made 111%, 107% to 18, 70% to 19. Today I closed a spread on Salesforce.com. I made 25%. I sold a spread on PayPal. I made 50 cents. and I sold a long-term call on Albemarle. Right, I bought it at 990, closed it at 2130, and made 115%. There should be a percentage there. Now, the Albemarle call wasn't scheduled to mature until January of 2021. But today it went up so hard, and we were up so much money, over 100%. I took the profit on the contract. This is just today. I closed these three positions, and I'm going to look for Albemarle to pull back. I'm going to get back into it and go back in with a strike with an expiration of January 2021. Now, if I go back, here's the offer. It's $697 for a lifetime license. Again, it's not a lease. And you get 1 month in the live trading room with me. I call all the trades. Yesterday we were done in 6 minutes. We had $540. You get the quick start guide, the free updates, and you're going to be in that live trading room. I didn't realize I wrote it twice. And if you're one of the first 5 orders, you're going to get the options alert, all my options picks, all my micro cap and small cap biotech picks. And you're going to get that perfect options master class as just simple add-ons. Now, our phone number is 786-732-4656. Somebody's on the phone right now if you're interested in coming along or coming aboard. And, would love to see you. Unfortunately, I don't think I have any time for questions. If you do have any questions, just give us a call. But we are profitable almost every day in the live trading room. Not every day, but I'm going to be there to trade the system with you. So your learning curve is going to be extremely steep. And we're going to do that master class to really get you honed in on exactly how to trade. But those key forces and that oscillator entry are always going to line us in the appropriate direction. And we're going to run over the other guy who's caught in the wrong counter trend direction. And again, I'm going to close with this. We're up against the other small trader. If we can't take that other small trader's money home every day, well, shame on us. Because we're going to trade with the institutional money. We see the direction. It's outlined for us clearly by the multi-time frame assessment of order flow, stochastic, and momentum. There are other rules. I wish I could have shown you more about the system. I have the system live off to the right, and I was going to show you how it looks. There are other indicators. We have zones of support, zones of buy-sell imbalance, where there's an overabundance of buyers and an overabundance of sellers based on a multi-time frame assessment. I just don't have time to show it. So I'm going to have to stand down now and give up the mic and just thank Michael for having me aboard. And I hope to see you in the live trading room because I'm there every morning. We grind it out and we beat up the other small trader. So listen, have a wonderful evening, and I really thank you for giving me your time.
All right, we want to thank Mark for joining us today, and